whatever advice that your buddy who did a successful startup exit 4 years ago telling you, like just throw out the window. Like it is completely useless to you right now.
Hello, Test Optimize Scale listeners and viewers. Have Youngro Lee here with us today, two-time FinTech exited founder. He's going to be talking about his experience at NextSeed, at Republic, and Brassica, which was recently acquired by BitGo. And he's the founder and CEO overseeing the RWA initiatives. We're going to be going in depth today. Youngro, thanks for taking the time to podcast with us.
No, thank you so much, Jason. Really, really great to be here.
And I understand a lot of the details in your background. Thought we can share the story with listeners, with the founders, the marketers, the VC industry professionals that are tuned in at the moment. Where did it all begin for you?
Yeah, it's really a long journey. And it's funny because when I get questions now from other, let's say, founders or folks who are considering founding companies, they kind of ask me, like, how did you do it? This is my truthfully honest answer. If I knew 10 years ago, which was when I left my previous career as a corporate lawyer to start my first company, NextSeed, I honestly tell them, if I knew back then what I know now in terms of how to, I guess, start and grow companies, there truly is. I would not have started the company. Like the startup journey is a lot different. I think when you read books or even candidly listen to podcasts like this versus when you're actually doing it. But having said that, I also think that's the reason why I even survived this long, which is I didn't know what it entailed, and sometimes ignorance is a blessing. And I think the desire to try to do something, candidly, was the reason why I kind of ended up here. And in a nutshell, I was a corporate lawyer. I did private equity, fund formation, investment type of work for about 8 years. I'm starting in New York. I worked around the world, including in Europe and in Asia. But the one thing that really got my attention over the course of my career, a legal career, let's say, which started in 2007, which, as you may know, was the start of the original global recession,
right,
about 50 years ago. There was a lot of changes back then also happening. A lot of startup blockchain concepts kind of started around that time. But really over the next 8 years, just realizing how much disruption both was taking place and could take place. And I guess the culmination of that was, I'm sure folks and listeners of this podcast know, the Jobs Act that was passed in 2012 and officially became implemented a few years after that. When that happened, that really caught my attention, having been working in the private equity industry. And the entire point of private equity industry before the Jobs Act was you basically let only a certain type of people invest in private companies, whereas after the Jobs Act, you broadened that pool tremendously. And as they say, the rest is history.
That's right.
Yeah.
And why fundraising? Why the Jobs Act? What do you see available in the future for the democratization of access to investors for founders, and that same type of access available to investors of early stage companies?
So this actually, again, I think in hindsight, a lot of things happened in my career, without any conscious thought. I just happened to be at the right place, right time in terms of getting exposure and feedback about different topics that kind of inform my views in the future. But kind of going back to 2007, 8, 9, the financial crisis, what it really did is shine the light on the capital markets, the public capital markets, and the inefficiency of them. And a lot of people at the time obviously lost a lot of money, and a lot of damage was done to the global financial system. The conclusion I made, at least at that time, as a young attorney in my early mid 20s, was basically capital markets, public markets, is not as efficient as we all assumed. And really, from then on, the private markets, which I know private equity sometimes gets a bad rep, but the idea of private businesses being able to make really fundamental changes to technology, innovation, economy, that really struck with me. But then, and that's really why at that point I did choose consciously to go into the private equity industry as a lawyer. And then when I was working in that industry for, as I said, 8 years around the world, that's when I realized, hey, there is indeed tremendous opportunity here for everyone, the entrepreneurs and the investors. But guess what? That investor pool is highly limited, not even to rich people, candidly, but the average colloquial rich people. It's actually reserved for really institutions and much, much bigger institutions. So it's basically this very small group of potential investor base that essentially picks the winners or potential winners of everything. And to me, this is not a political statement. A lot of people associate that, unfortunately, in this today's climate. It's not a political statement, in my opinion, to say if you have more people, like individual people, not corporations only, if you have more individuals participating in the success of an idea or a project or initiative, by definition, that makes that project more resilient, that company, better representative, more optionalities, and that really helps the global, in my mind, like the global opportunity set. And that's really why I felt so passionate. If we can expand the private markets to be more inclusive as an economic matter, that will by definition help everyone involved in the ecosystem, which again is entrepreneurs, investors, partners, and frankly the community that supports that enterprise.
With that strength in numbers. So instead of it being a few angels, a few VCs determining in the, let's say, top startup cities of the US or world, which groups are going to go to market next, you're bringing in thousands of investors for a Reg CF, a regulation crowdfund, up to $5 million retail or credit from those. I find $1,000 average investment. Maybe it's $3,000 if they're self-publishing, but let's call it 1,000, 5,000 investors to close out a round. But there's groups that boast over 60,000. Over 40,000 investors at this point. So that's a strong gathering of people who all have a position. They're all shareholders in these organizations and can have an influence perhaps on the trajectory of many areas of that business. More importantly, they're ambassadors. They're able to get out there and promote and talk about ideas with the outside world. But as that investor base grows, like you mentioned, it's just more resilient.
Exactly. Yeah. I mean, there's so much has happened, obviously, over the last, almost 18 years, actually, if we count 2007 as the start of this new world order. And the thing about these, I guess, I don't know what you want to categorize it, industry changes or industry theses or philosophies. A lot of people in the beginning, I remember, was very skeptical. I mean, there people are still skeptical, actually, about these legal mechanisms or legal offering exemptions, to be technical, that allow more people to participate. It's the typical arguments like, the average person doesn't know investments. They obviously have a lot of risk factors associated with it. What I think the industry has shown is actually all those factors that people were concerned about. I'm not going to say they're non-issues, but that they have not stopped innovation. They have not stopped ultimately the overall success, because the ultimate result of all these changes is there is, in fact, so much more companies that exist today that would not have existed for those opportunities, like so if you compare the time period before these laws existed. So I think time will tell, obviously, but it's also really important to understand it hasn't been that much time, right? It's I think 2015 is kind of officially the start of the 2016 actually was the start of the SEC implementation of Jobs Act, Regulation Crowdfunding. And if you look at the history of that movement, we're really still, I think, I don't know, top first half, bottom half of the first inning. Like there's a long way to go.
Unfortunately. I actually thought it was going to happen much quicker and started working on Reg D 506C campaigns, allowing for solicitation to accredited investors in 2015. Was told about Reg CF and had advertising live day one back in May of 2016. We started, I remember conversations leading up to it. Yeah. And that was 8 years ago now, which is
Yeah.
wild to think about, and
Yeah.
a whole nother story about how life and time flies. But 8 years,
Yeah.
2023, there was 1,434 Reg CF campaigns that went live.
Mhm.
Far fewer Regulation A Plus campaigns as tracked by King's Crowd. We get a lot of our data from there, as well as
Yep.
Crowdfund Capital Advisors.
Yep.
And I think that's extremely low. I find myself explaining to people what equity crowdfunding, or I should say regulated investment crowdfunding is on a
Yeah.
daily basis, where I
Yeah.
hear about other, we'll call it alternative markets,
Yeah.
more commonly in many cases.
Yeah.
I saw the, Web3, that's what we call it now, but, cryptocurrency,
Yeah.
spike
Yeah.
2017, all the different waves all the way through. And it was the opposite. People were telling me about, Bitcoin and alternative coins and meme coins on a daily basis. So
Yeah.
I think it's the liquidity. I think with more investor success stories, there'll be
Yeah.
more of an audience. And hopefully, 8 years, we're getting closer to some of those larger exits. There's already been companies to IPO, but I think, some stronger investor success stories, because I believe the founder success stories are there. But, how many companies incorporate in the US a year? What percentage of them are undercapitalized? How many more could be using these vehicles? Those are questions I ask myself daily.
Yeah. No, I'm glad you mentioned Web3 because there's actually a very, in my opinion, direct correlation and really comparison between the, let's call it the online investment crowdfunding industry. I know there's different ways to describe it, but just use that term
Mm-hmm.
versus let's call it the crypto industry, because they started around the same time. And the honestly, the big difference is one industry was regulated, one industry was not. So when I left my legal career, I came back. At the time, I was actually working in Asia, and I came back to US to start NextSeed. Uh, we actually, for example, started even before the Jobs Act became implemented nationally. We started a Texas intrastate crowdfunding rules under Texas state rules because you could do that before the national rules. And then when the Jobs Act did get implemented by SEC, we got so next year we were literally the very first funding portal approved by SEC for that funding portal license, and we closed the first ever Reg CF offering. That was 2016 summer. I can't even begin to explain you. We need another podcast to even explain what it took to get to that point, because every step of and this is what people don't know, there's so many back-end issues that needed to be done or that needs to be done to affect a investment offering online. Because if you think about it with common sense, making an investment is a lot more than just moving money. I can't just wire you money. Hey, Jason, here's $1,000. Give me a share. Unlike Venmo, it's like I give you $1,000, we're good. But if I'm investing in your company, there's a lot more. Like one, I have to have evidence that you actually own your company, for example. I have to have evidence that you're going to legally transfer that company interest to me. I have to have evidence that you're going to, have an account that where the money goes to. You have to have evidence that I am who I am. You have to have evidence because there's KYC and all kinds of other regulatory rules around like who you can accept as investors, millions of things. So I think that's what the first generation of, let's call it, investment crowdfunding startups. There was NextSeed. There's a few names, I think, like Republic, Seed Invest, Start Engine, WeFunder. There are a few kind of OGs, if you will, that kind of started in that space way back when. All of us had to figure this stuff out, which didn't exist. I'm sure, I don't know what the other founders did. From my perspective, I actually assumed, this is just, I didn't think about those. I thought, oh, if I get this SEC license, I can start doing stuff.
Mm-hmm.
And then one of the rules, for example, was like, hey, you need a qualified third party to hold the escrow accounts for which you can hold the money during the investment campaign to deliver to the actual company. I'm like, okay, no big deal. I probably talked to at least 50 different banks, if not more, and nobody, not a single one, either offered that service or was willing to do that service, because I didn't know about banking rules at the time. And so all those pieces, we ultimately ended up working with a local Texas community bank to kind of set up our services and have a banking partner to kind of go with us. But it's hard. A lot of those companies, and one of the reasons why the investment crowdfunding people just look at the like you said, like the headline numbers and say, why didn't it grow faster when that? truly, and as an insider, I know one of the reasons was because there literally was no infrastructure that can support that kind of mechanism where I'm trying to get 1,000 people to invest $100 each into a company. Like, what kind of bank is going to process $100 investments, for free? Because
Hmm.
usually the fee for wire is $25, and who's going to pay $25 fee for $100 investment, right?
Right.
So that's one of the reasons why the infrastructure of the regulated securities market, uh, because it wasn't there, that industry hasn't grown as quickly, and is still it's getting better. And we can talk about this later, but that's why I started ultimately Brassica, to solve some of those infrastructure issues. But that's progress. You compare it to the Web3, it's kind of like moving money, back and forth, even more than moving money, because you don't use banks. When you have a wallet and you literally send crypto from one address to address, literally you don't need banks, right?
Right.
So in the beginning, when these assets were created, quote unquote cryptocurrencies, I mean, again, that's a whole different. I don't want to get too much into the merits of cryptocurrency itself, but the idea is actually relatively simple, right? It's basically a structure, a code base, or however you want to define it. But you have now created this thing, and the value of that thing is based on what people attribute value to it. And I think over time, especially in the, let's call it 25, 6, 7, 18 years, when Bitcoin first obviously got released, and then Ethereum came on, and when that industry grew, like literally from the start to, let's call it, the FTX crisis, so about period about, I don't know, is that 6, 7 years?
Hmm.
Zero regulation, right? Literally, as long as people could find a technical solution to create a wallet, make sure the code base that reflects the blockchain assets are there, and
Hmm.
then someone else has a wallet, free for all. And so you went from zero to literally like $1 trillion industry overnight. And that's kind of where the world started emerging, because now, after the FTX crisis and all the ups and downs of that bit, now regulations are coming in. And now people are thinking about, okay, instead of just moving, before people thought I could just move, my blockchain asset to you and then we're good because it's not a security. Well, now SEC is saying it is a security. Guess what? The only way to sell and distribute securities to a mass audience is investment crowdfunding rules, is regulation crowdfunding, Regulation A, even Reg D, if you want to do a credit investor broad solicitation, as you guys know. So that's where we're a really interesting space, because this massive industry, which is crypto industry, was able to grow and basically get it to a point of legitimacy because there's no regulation. And this much smaller industry, which is the investment crowdfunding industry, that couldn't grow to that size because of regulation. But now those two things are intersecting. And that's where things like RWA tokenization, RWA offerings, and all those terms are coming up, because now you have to merge those things to actually have a future. And so, one, maybe to kind of summarize everything I just said, it's been a 10+ year journey, not just for myself, but everyone in this industry of both the investment crowdfunding space and, let's call it, the Web3 crypto space. And both sides are now talking.
Yes.
Obviously, probably my former company is an example of that, but it's an interesting time to be for the industry participants.
And it's so funny you bring it up because they were two different worlds for so long.
Yeah.
If I tried to show a Reg CF, Reg D, Regulation A plus, I mean, hey, Reg A plus, up to 75 million, or even years back when it was 50 million before 2001, I would see eyes roll if I was speaking to a cryptocurrency company. I was, we're doing something completely different. Where, like you mentioned, you're trying to follow regulation. Hey, corporate lawyer background, this is what's happening. These are the vehicles to use. You want to be compliant? I mean, hey, I think it's very important if you're operating within the US and touching, cryptocurrency or digital assets in any way, to be compliant. I mean, we've seen what's happened with Binance, who thought they were following all the rules, and we've seen what's happened with bad actors. I mean, they can apply new legislation, new regulations at any point. I think you need to be following everything to a T. So why not use these filings? Why not do a private sale type? What would historically be a private sale for cryptocurrency, but use 506C, and it's public offering at that point to accredited investors, but you're going after those larger increments. You could set your minimums accordingly. I'm a big fan of incorporating retail and even working in the public space on micro cap deals. It's, hey, retail can really move things. It could create excitement. I mean, we've seen it in various activities this year, in 2024, past years, in the more mainstream public markets. There's been a lot of news headlines around some of the stocks, but to the resiliency, the strength in numbers that we've spoken about. I mean, you could launch a marketplace. You can have a whole ecosystem living just among the retail investors that are shareholders. I guess we should talk about RWA tokenization a bit more. What does that mean? I mean, we've seen Reg CFs. We've worked on Reg CFs for years, that bonus tokens. You mentioned Republic. I know you were over there for a while. I mean, what's happening in the RWA and tokenization space right now?
Yeah. So it's funny because RWA, it's funny how like some certain phrases become buzzword. RWA stands for real world assets. Mm-hmm. What is real world assets? It's literally everything. Everything except crypto is real world assets. And so the alternative we use the term alternative investment historically, as you know, to define non-public securities. And when the investment crowdfunding started, we categorize these alternative assets, but really using today's standards or definitions, like this industry, the investment crowdfunding industry was the RWA industry. Mm-hmm. Right? Tokenization is simply the crypto or blockchain application aspect of these assets, because frankly, if you again take a step back, the reason why these problems exist, a lot of people again kind of get focused on the technology. In fact, that was probably the issue with a lot of crypto companies who started getting into RWAs like 4 or 5 years ago, or even earlier. My favorite quote, and just to take a detour, like my most favorite movie, one of my favorite movies is Jurassic Park, and I love that quote where I think it was the doctor, I forgot his name, but there's a quote like scientists thought about what they could do, and they didn't think about what they should do. So to me, the crypto industry, as it relates to RWA, is kind of that experiment where they were like, oh my God, we can tokenize real world assets. And everyone did it and invested God knows how much money in development infrastructure. And the reality is like, well, so what? Right? Just because you tokenize something doesn't mean people are going to buy it. Doesn't mean the asset's better. Doesn't mean in any form. It's just the new technology. So why is that important? Why is that this important? Because the reason why the technology is important is basically because in the traditional world, it's hard to move and sell assets around because of all the regulated aspects, right? Because securities is governed by different sets of rules than, let's say, moving money around. So in the public markets, you don't need those solutions, because there is a way. There is a massive multi-trillion market where I can buy a stock that's publicly listed. I can sell it whenever I want. There's full liquidity. And so we're good. In the private markets, none of that exists, right? So as I mentioned earlier, like things like title, escrow, like verification, KYC, when in a world where you don't have those things, how the heck do you actually make it cost efficient? Because right now you're basically paying a lot of middlemen. So tokenization in a nutshell is, I define it as blockchain-based solutions that essentially takes the middleman out and allows, because all the data is obviously there, in a verifiable way, in an indestructible way. So for people to trust that transaction without having a third party involved. So RWA tokenization is really a mechanism, in my opinion, that allows quality assets, to the extent they would like to distribute to a much larger audience and create a marketplace, to do so in a much cheaper way. It dramatically reduces transaction costs. So in order to get to this point, I feel like we're finally at the point where people kind of understand it. And trust me, it's because they have to. Like, people never will do something unless they have to. Until SEC came down, you can argue about the merits of SEC's philosophy and whether the SEC is taking aggressive or non-aggressive. It doesn't even matter. That life, stuff happens, right? Because SEC over the last few years has cracked down on some of these issues, the traditional crypto players who are thinking about RWA as a holy crap, this is amazing technology, are forced to reckon with the securities laws. And now that you are doing these things, that's when RWA tokenization projects are being led by, candidly, institutional players and startups like Republic that do have that traditional finance experience and legal regulatory compliance issue experience as well. Because if you don't have that background on their traditional financial system and traditional securities laws, you can't do it. Like, you literally can't do it. Although you're just breaching laws and probably go to jail.
Mm-hmm.
So I would say where we are today is now truly the beginning of RWA tokenization as a technology that will have actual application to real life because they're forced to. Right. Hopefully that makes sense.
Absolutely. And digital assets. Hey, who says NFT anymore, right? All of these different projects. I saw, scratching the surface of real world assets behind it. I wish some more of the stable coins had real world assets behind it, and it led to some of the crashes a couple of years back here. But it's like you said, we're in our infancy for all of this. And, I used to hear about fundraisers 2009, 2010, that, weren't quite following, the right rules here. And I think the path is very clear now for issuers, for founders. I got into this whole space of investor marketing, investor and user acquisition because of the need that I saw.
Yeah.
Groups were failing without the right capital, and this is the approach for them.
Not even right. I mean, that's why I really appreciate kind of podcasts like yours and kind of like your personal role in this kind of conversation, because a lot of people jump to conclusions without actually understanding the underlying issues or problems in that matter. So even now, when people talk about RWA tokenization,
sure,
again, it's kind of becoming a buzzword again. But they point to, for example, like BlackRock, BitGo, and some of these like products. I won't go through the name, but like if you look at BitGo as an example, the minimum investment for that is $5 million. There's only a handful, like literally dozens of institutional capital that are using that basically to find a way to earn yield on their crypto.
Mm-hmm.
So people talk about BitGo as oh my God, we have RWA tokenization innovations, and there's other companies like that in that category. If you actually look under the hood, people like you and me, like it's completely irrelevant. It's more than useless because there's nothing we can do about it. It's required for qualified purchasers. So if you're really thinking about, okay, the whole point of this was, again, how do we make it easier for a massive number of people around the world? And that's a whole different component we can talk about, because international complicates some of these things. But if you think about it, then again, the tokenization side, the benefit of the innovation was not that you can move $5 million checks around. If you have the ability to put $5 million at a time in treasury bonds, like you don't really need tokenization. I just call my brokerage and I just get it. It's in fact more work and more expensive to do tokenization in that way. So I think that's the interesting area, is the innovations that's happening in this new space right now is limited to, frankly, purely institutional, like higher ticket items. The future is, how do you bring that down?
Mm-hmm.
Right? How do you bring that down? And that's where I think it gets interesting. I mean, I'm an entrepreneur at heart. Like, that's the opportunity for all the let's say hopeful fintech entrepreneurs and startups. I mean, I'm so passionate about this space. Like, that's it, right? Like, because the institutions like Goldman, BlackRock, all those guys, like they don't know how. They literally don't know how to even tackle this retail space. And it will be really exciting to see what happens there.
And for the groups that are listening that are not BlackRock, and they're launching their own raises, with your experience at NextSeed, at Republic, with what you guys are doing at BitGo, and participation in this whole regulated investment space, what recommendations would you have towards their own capital raising efforts, their own initiatives? What should they test out to be able to see success? Because I believe there's many misconceptions in the space, and this notion of, hey, if you build it, they will come, Bring on legal, bring on your audit, list on a portal, use a tech platform, get your deal up and running, and you could raise $5 million, from retail and credit investors, set your valuation. Yet, 2024, I was looking at the King's Crowd data. As of July 1st, there was only two issuers that have done that. There was 11 last year in 2023. Regulation A plus stats aren't great either. Does that mean founders should not use these different approaches? Absolutely not. It just means they should, anticipate how much traffic they're going to need, how many investors they're going to need to get to that deal to be able to fulfill the round. Like you mentioned, there's going to be resiliency. There's going to be a lot of value to them by utilizing this type of fundraising versus, one investor, a few investors, VCs. You hear horror stories of companies being taken over, and friends with a lot of VCs. That's not to knock them at all. It's just to say that these are powerful tools. How do you use them to succeed and hit your full goal?
Yeah. This is a very, very complicated question. So I'll try to summarize as best I can.
Sure.
I think people, let's just say startup founders, they shouldn't assume that just because these other tools now exist, like CF, that it will be easier for them to raise capital. All it means is that there's another tool that you can consider if your company is appropriate and well positioned to take advantage of it. So what I mean by that is it starts with the type of company that you have. There are companies that are venture backable businesses or suitable venture capital. There are companies that are not. There are companies that benefit from having, let's say, a really, really smart, let's say, experienced venture capital type investor to give them strategic advice planning. And that's what they need because they're trying to solve a really complicated technical problem or get into a very complicated organization as enterprise sales. If that's your case, to be honest, retail audience isn't going to help you. On the other hand, if you are a business that frankly don't need that expert advice because you are the expert, and let's say you're a retail-facing business like a restaurant or a gym or a hotel or even a tech startup, but consumer-based like B2C kind of company, then yes, absolutely, the value to you of having 50,000 individuals who have a vested stake in your business and 1 million visibility, whether they invest or not, that's valuable. So if you are, what I tell honest entrepreneurs is if you actually benefit from having the entire world knows about your company right now, because they can buy something, click a button, buy something from you, 100%, you literally need to consider every single option, investment crowdfunding. If that's not what you need, you just need the money. There's probably other ways or different ways you can consider it, because as you know, it's not easy to do XCF. It's not free money. So that's where maybe to go one layer deeper, to the extent you do want to consider these alternative forms of financing strategies like these investment crowdfunding. I will say, and this is a part that a lot of entrepreneurs start doesn't know. Not all funding portals and not all investment platforms are created equal. They literally say the same thing, and because they're all following the legal exemptions. But you got to look under the hood. Who's their custodian? Who's their financial providers? Who's their backup? I don't want to talk negative about any other companies, but we see, for example, right now, Synapse and Evolve Bank has a lot of issues, causing a lot of issues because those players were actually a big part of this industry, candidly. They provided escrow services and payment services for this industry. And now a lot of these platforms, they're done because the backup, the vendor risk of an investment platform is so massive. If their under the hood banking partners fail or don't work with them, that business doesn't exist, right? And that problem is why literally we created Brassica along with our various partners after I transitioned from Republic, because the entire point of the Brassica system, we created our own. We literally got our own trust company, and we have our own SEC transfer agent, and to be able to thoughtfully put together the SEC requirements as it relates to tracking your ownership table and legally verifying to the company and the investors who owns what, and matching it to the banking infrastructure that can actually legally hold money. Because literally, if we mess up your money, I go to jail. That's the level of commitment I have to make to get that license. Whereas a lot of companies obviously, didn't, and that caused issues. So that was a solution that we made. And for example, we work with Republic, and so Republic integrates with our services for that reason. And that's literally to be able to give comfort to both issuers and investors that once you complete this process, your assets, never say never, but they're safe, right? Because they have different kind of protections in place. As a founder, often you're so focused on the immediate goal of like, I need X dollars to do this one thing. They don't think about the potential liabilities or the potential problem that will arise if something else happens in the back end. That's, I think, what I would tell the entrepreneurs out there is like, when you look at the investment platforms that could potentially help you raise money, and broker dealers and basically placement agents, make sure they're regulated, make sure they have a track record of delivering success, and make sure you are comfortable with their back end service providers, which is very, very important. You can use that same analogy to the crypto industry. Frankly, why I was attracted to and why I joined BitGo and vice versa. BitGo is a gold standard. Like, there's very few companies that have actually lasted over 10 years in the crypto industry, and it's a stalwart. I mean, obviously, as an example, in the ETF industry, BitGo and Coinbase are the two main custodians in that space. But coming from that background, because I knew that the future of this, well, not new, I believe the future of industry is in digital. Everything we're talking about will be digital, one shape or form, whether it's tokenized or not. It will be in digital form. So
Sure.
then when I think about the security of the private security, the lowercase security of the private securities, you have to basically be able to protect that on behalf of clients. Because BitGo's reputation and history proves they're, I believe, the best in industry in terms of the security side. I need that on the digital asset side to pair with the traditional asset security side. And by combining it, that's when you can ultimately provide, for example, security of tokenized assets. Because now you're protecting securities of the equity ownership and the digital asset ownership. I mean, we can talk about this forever, but I guess the main point to summarize everything I just said is, if you're a founder or a project leader, whether of a traditional company or frankly a blockchain asset or a tokenized asset, any of the above, the number one thing that I think people are not looking at that they should, beyond the immediate can I get the money or not, is the service providers and the vendors underneath the hood. And people will need to keep tracking of it even more so in the future, because laws are changing, banking regulators are changing, securities regulators are changing. Who knows what the new election will bring, because there might be new leadership at these agencies. It's complicated, but you have to think about those.
I don't always think about that. And I'm now scratching my head, and I can connect the dots. Portals that were affected, definitely on the crypto side, and domino effects. So I'm now asking myself that question. To the nature of the show, test, optimize, scale, I ask an optimization question here next. And I normally am asking around issuer success. Mm-hmm. So, if a campaign's not working right out of the gate, how do you manage it to a point of effectiveness? What are the best approaches? Even if it is, how do you find those pockets of performance to be able to, refine the results that you're seeing? Yeah. But I'd like to shape it a little bit different with you. What if you find yourself in a situation like that? Because there are plenty of issuers that tune in here. They're already live. Let's say they do a little digging and find something's off underneath the hood. Yeah. Or an issue emerges, which it's a matter of time, right? So something comes up. How do you optimize? How do you change your stack? How do you continue to make those steps to see your campaign succeed? But especially if something is out of order under the hood.
Yeah, I mean, I'll give you a simple answer given the time constraints. You have to work with the right partners. And if you don't have the right partners, you need to get right partners ASAP. Because as a founder, you hopefully are a subject matter expertise in the actual business of the company. Right. It is impossible for you to try to be a subject matter expertise in these other aspects, whether it's the marketing side, which say if you have problems, hire Jason. There are people that are specialized in this area that just to save a buck or two, it's just not going to be worth it. Same analogy to back-end providers, investment platforms, funding portals. There's a track record for a reason. Literally look up whoever is selling your service, ask them and verify how long have you been doing it. If someone just started it last month, that's very different than a company that's been doing it for 7 years, right? If you think about the banking industry, okay, think about what impact the banks will have on your business. Um, and if you, I mean, I don't want to dive too much into this because it's so sensitive. But a lot of people just assumed it works because they say they're a bank or they're this service provider. But if you actually look at the history of these companies or these service providers, you can actually find things out. So obviously, the best step is before you make these decisions, consult with the right partners to make the right decisions. If you're already in a situation that things are going bad, honestly, the best solution that I have is like find the expert ASAP and depending on the situation, work with them, get their advice, get their consulting, whatever you want to call it, and try to rectify it because it's not even that one problem. Like if something goes wrong 2 years from now, 3 years from now, that's even worse because now
Mm-hmm.
you probably have a company and one day your investor might be wondering like, what the heck do I own? And worse, if you have issues like that, there's no way a future venture capital or future investor will invest if they think the history of your company, fundraising or otherwise, is unreliable.
And I fortunately have seen that, firsthand. I've seen, it rectified some pivots. What about scale? To end on a higher note here, what are some tips? What are some examples based on the biggest successes you've seen?
Scale of the operating business or kind of the
Yes.
fundraising side? Yeah.
Yeah.
So on the
A combination of both, perhaps, but yes.
I think it's funny, like the world today, even in a limited time, is very different than when I started in 2014, 15 from a startup, obviously. So for me, the scalability basically means in this industry, sorry, in this time, because the whole capital stack is just in flux, both the VC side and the investment company side, to your point, because of macro issues, it is a fact. There is lower demand and frankly lower capacity for anyone, whether you're a millionaire or just a typical investor to deploy capital. So that's a fact. There's less capital available. So then what it really means for scalability in this market to me is like you got to increase your optionalities, right? The previous like advice, if you want to call it that, of like do one thing well, generally it sounds good, but in reality, if that one thing fails, like you're done. So you got to have optionalities. And the moment you have optionalities that actually result in something that you think turns, then just do whatever it is to kind of maximize the scalability find of it. That scalability really, really depends in this market of a heightened regulatory sense on the back-end providers. So having a good foundation as a baseline, and then building a lot of optionalities around that, both as a business model and frankly, capital raising strategies. So yeah, talk to venture capitalists, explore platforms, talk to your grandma, like whoever it is. And then as you successfully, hopefully reach milestones, like same thing, never change that format or the mentality of create more options. If you think you have different options, create more options, create backups, or at least know the backups to your vendors and so on and so forth. Like I think for the next, I mean, maybe forever, but at least the next few years, I just think we're in a completely, different world than people thought. So whatever advice that your buddy who did a successful startup exit 4 years ago telling you, they just throw out the window. Like it is completely useless to you right now.
And imagine where it's going to be 5-10 years down the line.
Exactly.
Well, Youngro, thank you so much for taking the time to educate our listeners, share your stories. Again, with the exits, with what you've been able to accomplish, with what you're focused on a day-to-day basis, this is invaluable, information to take in.
No, I mean, I'm always like I love to help. I mean, and I don't mind. My email is youngro@bitgo.com. Especially for even the service, really service providers, issuers that are looking for better infrastructure solutions to basically serve your customers. Like B2B2C is really the category. To the extent that you're looking for stronger, better, I guess, infrastructure, both in the traditional securities world and the crypto world. Our team is here to help, and just as hopefully the audience can get, like I'm so passionate about this from a startup perspective. So I think we need to help each other.
Absolutely. And definitely encourage the audience to do so. There's your contact info. Youngro, appreciate it. This is, I'm taking a whole page of notes I'm going to be sharing with my team here. Thank you for taking the time to join the show here today.
No, thank you again for having me. Let's hope that the future is brighter than maybe the last couple of years.
I believe it will be. I believe it's going to pick up, even if it has to go down a little bit first. But hills and valleys, and if there's a stronger way of doing things that emerges, I know we'll both be, following and look to get involved as well too.
Definitely. Thank you.
Yep. Awesome. Well, I want to thank everybody for tuning in. We'll see you next time. Take care.